In 1929, Goldman Sachs did something almost nobody remembers. They built a stock fund with $1 million of their own money, then sold it to the public, every bit, for 10 times that amount, a fortune. Then they used the public's own money to buy back their own shares, their own, to pump the price high and fast, right before the crash came, when it finally collapsed. The Goldman's partners lost $13 million. Just that. The public lost something closer to 475 billion, a debt in today's money, adjusted for now. Now back to the vault. We go into the shadows. You have never heard this story. That is not an accident. That is the business. This is the truth of it. 78 years later, they ran it again. In the shadows. Same trick, new paperwork. This time, a mortgage bond. Sold to banks, to pension funds, all over. To insurers on the other side of the planet. And quietly, with their own money, it failed. Goldman got paid twice, every time. Here is what should actually worry you. The man who approved the bailout that made Goldman whole, he used to run Goldman. He was them. For over 100 years, the same circle has moved back and forth between power, writing the rules, breaking the rules deeply, rewriting them again, over and over. And in 2016, the firm that spent a century selling other people things too complicated decided to buy something it didn't understand. It went about as well as you'd expect. The pattern is older than the mortgage bond, older than the bailout, older than almost anyone currently working at the firm. The exact same play for over a century. This is Strategy Lens. We spend hundreds of hours per documentary reading court filings, searching, and congressional testimony. Most people will never. So you don't have to. We do the work. Every week, we take one company to pieces and show you the part they hoped you'd never. Not speculation. Documents, settlements, truth, and sworn testimony assembled into a story. Subscribe and you'll stop reading headlines about Fortune 500 companies the way everyone else does. You'll already know what's underneath the headline before it is. Now, back to the vault. We are returning. Goldman Sachs did not begin on Wall Street. Not at all. It began decades earlier with a peddler's cart. A humble start. Marcus Goldman arrived in America from Bavaria in 1848, one of thousands of German Jewish immigrants fleeing economic collapse, seeking new life and anti-Semitic violence in Europe, a world on fire. He spent 2 decades doing what new immigrants with no capital and no connections did at the time, selling goods door to door in Philadelphia, building his reputation, then running a small clothing business, building his capital slowly and surely, slowly saving enough to try something bigger. The dream was growing. In 1869, at 50 years old, Goldman rented a one-room basement office on Pine Street in Lower Manhattan. It was small, next to a coal chute. It was a humble, gritty start. He had no bank charter, no partners, just himself. No name anyone recognized. A blank slate in a new world. What he had was a simple insight. Small merchants across the city needed cash today, and they needed it quickly. But their own customers wouldn't pay them for 60 or 90 days. Time was money. So Goldman offered a deal. Hand him your merchant's IOU, his promissory note, to hold, and he'd pay cash for it right now. Cash in hand was king. Less a discount for the wait and the risk. A fair trade. He'd collect the full amount himself. Later, the system worked. This is called commercial paper. It sounds boring on purpose. It was the beginning of everything. Foundation. Goldman worked this trade the way his old peddling roots worked, on foot, carrying the notes tucked inside the lining of his hat. Securely. Because he didn't yet trust a briefcase to hold them safely. Not yet. Through a full day of Manhattan traffic, a busy world. Every note he carried represented a personal judgment call about a merchant's honesty and a business's real prospects. Every day. Judgment he had no formal training to make. He just knew. And no institution backing him if he got it wrong. He was alone. He simply got very good at reading which promises were likely to be kept and which weren't. That skill, more than any specific product, is arguably the actual asset the firm has been selling for over 150 years since. a long history. He was locked out of the banking establishment by design, not by accident. The major banking houses of the era, run by old money Protestant families, established, did not open their doors to German Jewish financiers. Doors were shut. So Goldman built his business in the one lane nobody else wanted: grit, unglamorous, high volume, relationship driven debt brokering. The work that required knocking on doors the elite banks considered beneath them. Pride. His son in law Samuel Sachs joined the business in 1882. By 1885, the firm had a new name: Goldman Sachs and Company, a legacy. By 1896, they were moving $30 million a year in notes. Heavy lifting. And the firm listed on the New York Stock Exchange with 1.6 million. The main stage. Say a dry goods merchant was owed $1,000 from a retailer, due in 90 days. A debt. He needed cash now, not in 3 months. Ready money. Goldman would hand him, say, $970 today for now, and keep the right to collect the full thousand when it came due. The promise. The merchant got liquidity immediately. Goldman got a $30 spread for taking on the risk, a tidy sum. Multiply that across thousands of merchants every week for decades. Growth. And you get a firm quietly compounding a small, repeatable edge. Capital, without ever making or selling a single physical product. Pure profit. That is arbitrage in its purest form. It is pure strategy. Profiting from the gap between what something is worth today, strategy, and what it'll be worth later to someone else at some other time, profit. It is a completely legitimate business, the foundation of the firm. It is also the exact same intellectual instinct, the drive for more, that would later justify far more dangerous bets. High stakes indeed. Marcus Goldman's son, Henry Goldman, was the visionary, was the one who actually pushed the firm into modern investment banking. Power, co-engineering the Sears deal you're about to hear about. A turning point. By the 1910s, he was one of the most important bankers on Wall Street. Then World War I happened. The world changed forever in a flash. Henry Goldman had deep personal and business ties to Germany, a conflict, and he publicly opposed US support for Britain and France. Standing firm, refusing to personally buy the war bonds the firm itself was underwriting. His partners saw a firm's survival on the line. In 1917, they forced him out. The founder's own son, removed from the company bearing his family's name. Gone. Because his personal loyalties had become a liability to the image. Remember that sentence, because you'll hear its logic again and again. When personal loyalty and institutional survival conflict, the choice is made. Goldman Sachs has always, without exception, chosen the institution. Always. In 1906, working alongside Lehman Brothers, the firm took Sears public, followed shortly after by General Cigar, another success on the pile. And in doing so, it introduced a new way to value a company. Until then, a company was worth what it physically owned: heavy steel, its buildings, its inventory, its massive machines, industrial power. A mail order catalog business like Sears looked unimpressive back then. It owned comparatively little in the way of physical assets. Empty. What it had was a growing customer list, a trusted name, value, and a repeatable way of generating future sales. A system in place. Goldman argued Sears was worth that instead: its brand, its goodwill. Investors who bought in were betting on a story about the future, vision, rather than counting up assets in the present. Solid weight. That idea that a company's value lives partly in the intangible, in reputation and future promise, rather than steel and property. The plan is the foundation of essentially every modern stock valuation. The market. It is also a number nobody outside the deal can actually verify. Complex. Every time you hear that a startup with no profit is worth billions, high value, or that a technology company's brand alone justifies a valuation, dominance, you're hearing an echo of exactly what Goldman argued about Sears in 1906. A new era. The technique became the foundation of how markets price the future. Insight. It also means the future has been up for negotiation. The deal is on by whoever is trusted enough to set the number for over a century. Trust. And that is Goldman Sachs's real founding invention, the core. Not commercial paper, not the public offering itself, hidden depths. The idea that something's value can be whatever an expert says, authority, and the public has no independent way to check the math. Uncertainty. For a firm frozen out of the establishment, that idea was liberating. Nobody could gatekeep a number that didn't physically exist, locked away. For everyone else, over the next 120 years, it was a catastrophe. Because once a business is built on selling the unverifiable, the deal, the only real safeguard left is the character of the people. Leadership. In the 1920s, that safeguard would be tested for the first time. The trial. It would fail spectacularly and almost take the firm down. Reflection. There's a reason this particular firm, and not one of the old money houses, ended up being the one to push furthest into territory nobody could fully verify. The Protestant banking dynasties of the era, the Morgans, the Barings, giants, had generational reputations to protect and generational wealth already secured. They could afford caution. Marcus Goldman's firm had neither, no safety. It had spent its first 50 years fighting for legitimacy, persistence, locked out of the rooms where the safest business was distributed, exclusivity among people who already knew each other from church and club, connections. That outsider hunger became a permanent institutional trait, driven, passed down through every generation of partners that followed. A legacy, a willingness to go further into the unverifiable and untested. Fog, into the deal everyone else considered too complicated or risky. Danger. For a long stretch of the 20th century, that hunger read as brilliance, glow. It built an empire, a monument to ambition and risk. Empire. It is also, as you're about to see, precisely what nearly destroyed that empire, less than 60 years after Marcus Goldman first opened for business. The door. By the late 1920s, America was drunk on the stock market, and Goldman Sachs decided to stop just brokering value and start manufacturing it. In December 1928, the firm launched the Goldman Sachs Trading Corporation, a closed-end investment trust. Ordinary people could buy shares in it. Trust. And the trust would use that pooled money to invest on their behalf. Here's the part almost nobody knows. It's the hidden engine. Goldman seeded the trust with roughly $1 million of its own capital. It then sold shares to the public at a valuation close to 10 times that amount. Wealth. And then, using the trust's own cash, it began buying back its own shares. That buying pressure pushed the price higher. It was a loop. A higher price let Goldman sell even more new shares at an even higher valuation. Then Goldman built a second trust, Shenandoah Corporation, pushing further, funded largely by money from the first. Then a third, Blue Ridge Corporation, layer sitting on layer, a fragile stack, each one selling fresh shares to a public with no realistic way of seeing how thin it was. It worked exactly like a pyramid because structurally it was one, a trap. Money from new investors at the bottom was what kept the valuation looking solid. Picture three buckets stacked on top of each other, propped up by the bottom, piling high. As long as new water kept pouring into the bottom, the top two looked stable. The moment that new money stopped arriving, all three emptied out within weeks. It is also, not coincidentally, close to the same structure a Ponzi scheme runs on. The difference being that in 1929, building one on the NYSE was not yet a crime. Then the market cracked. The world changed in a single day. Panic. The trading corporation's value didn't just fall, it collapsed to almost nothing. Goldman's partners personally lost $13 million. Solemn moments, but survivable for a private partnership with other lines of business. Hidden. The public did not survive it the same way, not even close. Total loss. Total losses across the pyramid converted into today's dollars are roughly 475 billion. Nobody went to prison. At the time, there was no law against any of it. That absence of a law didn't last. Congress convened the Pecora Commission, hauling Wall Street's biggest names in front of the Senate to explain. Those hearings directly produced the Securities Act of 1933 and the SEC itself, the same agency that 76 years later would be investigating Abacus. Goldman Sachs nearly didn't survive its own crash. What saved it was a person. Sidney Weinberg had started in 1907 as a porter's assistant, cleaning spittoons, and rose over more than 2 decades into the partnership itself. Weinberg understood something the balance sheet couldn't fix: relationships. He spent the next 3 decades embedding Goldman inside corporate boardrooms, quietly advising multiple US presidents on economic policy. Influence. In 1956, he engineered the Ford Motor Company initial public offering, earning him the nickname Mr. Wall Street. He made them untouchable. Weinberg never actually fixed the internal culture. He simply made them untouchable. By the 1960s, power shifted toward traders. The most important was Gus Levy. Levy pioneered block trading, buying and selling enormous chunks of stock in bulk. His philosophy was blunt: your objective should be to win. Win all the time. Not sometimes, every time. For a firm built on selling things the public can't verify, win every time is a strange motto. In 1968, Goldman underwrote 100 million for the Penn Central. It failed. In response, John Whitehead sat down and wrote the famous business principles. Principle number 1 states plainly that a client's interests must always come first, warning that the firm's reputation is its single most valuable asset. A warning. Sit those principles next to Gus Levy's operating philosophy and see the truth. An official written conscience on the wall, and an unwritten internal culture. By 1999, the firm was one of the most powerful on Wall Street. The transformation. That structure nearly broke in 1998 when Goldman was exposed to the LTCM collapse. Senior partners led by Hank Paulson pushed John Corzine out of the way. Under the old structure, partners had skin in the game. Going public changed that forever. It made a couple hundred people instantly extraordinarily rich. Immense wealth. It also quietly solved a different problem. When a bet went wrong, it was yours as a shareholder, a client, or occasionally as a taxpayer. Inside finance, there's a nickname for what happened after the 1999 IPO, and it isn't a flattering one. People call it the Goldman Sachs Mafia, a nickname with a heavy history. Not because anyone broke a kneecap, because of where the alumni ended up. Robert Rubin, Goldman's former co-chairman, became US Treasury Secretary, and in that role championed the 1999 repeal of the Glass-Steagall Act, the Depression-era law that had kept ordinary commercial banking separate from riskier investment banking. That law existed because of 1929, because Congress looked at the pyramid, decided it should never happen again, and built a wall to stop it, a barrier. 70 years later, a former Goldman partner helped tear that wall down, and that repeal happened the exact same year Goldman itself went public. Henry Paulson, Goldman's former chief executive, became Treasury Secretary and would go on to oversee the government's response to the 2008 financial crisis. Oversight. Stephen Mnuchin, a 17-year Goldman partner, became Treasury Secretary. Gary Cohn, Goldman's former president, left to become a director. Power, advising directly on the same tax and trade policy that would shape things. Mario Draghi, a former Goldman director, ran the European Central Bank. Mark Carney, who spent 13 years at Goldman, went on to govern the Bank of England. Robert Zoellick, a former Goldman managing director, became president of the World Bank. Joshua Bolten, a former Goldman executive, became White House chief of staff. This is the answer to the question we opened this video with. Why does the same firm keep supplying the people who write the rules? Because for over a century, Goldman has treated service as a rotation. And when the people regulating an industry used to run the largest company, even when every individual involved is acting in good faith, it is about the structure of power itself. It isn't only personnel. Goldman consistently ranks among the largest sources and lobbying spending in the entire financial industry, funding the game, who sit on the committees that write banking regulation. the legal core. As recently as this year, Goldman's own CEO was seated at a state dinner alongside a sitting US president and the president of France. Global power. To understand why 2008 played out the way it did, you have to understand what Goldman had actually become. It was a transformation. Goldman Sachs had quietly become something else entirely underneath its name. Most people picture an investment bank as an advisor, a firm that helps. But by the mid 2000s, Goldman generated enormous revenue from trading, buying and selling bonds, currencies, and derivatives the way a hedge fund does, just with a much larger balance sheet and a much older name attached. Heavy. That matters because a pure advisory firm has a straightforward incentive: get the client the best outcome, collect the fee, protect the bond. A firm that is simultaneously trading against the market has an incentive, and that second incentive doesn't always point in the same direction. It was what happens when an advisory culture and a trading culture share the same building. By the mid 2000s, Goldman had effectively become something closer to a hedge fund, managing its own risk above all else, managing tens of billions of dollars in its own positions, on top of its client business. As early as December 2006, internal risk committees were already sounding alarms, loud and clear, about the US housing market cooling. Goldman's response was not to stop selling, they continued. The firm continued distributing over $200 billion in bonds, while its own trading desk used credit default swaps to bet against the market. One deal became the symbol of the entire era: Abacus 2007 AC1. The Goldman structured a synthetic collateralized debt obligation, essentially a bundle of side bets, and allowed a hedge fund manager named John Paulson to help select which mortgages sat inside. Paulson wasn't investing alongside the buyers, he was betting against them, short. And that second incentive doesn't always point in the same direction. Conflict. Marketing materials told investors the portfolio was independently selected. Truth. They did not mention that the man helping choose it was actively shorting the entire thing. Hidden. Investors lost roughly $1 billion combined. John Paulson personally made $1 billion. Goldman collected its structuring fee from both sides of the same transaction. Double win. In 2010, Goldman paid $550 million to settle fraud charges, the largest Wall Street penalty of its kind at the time, a massive consequence of the play. The executives who oversaw the entire mortgage division above him largely kept their jobs, selling instruments to buyers who had no real idea what was coming next. Pure confusion. The executives who oversaw the division above him largely kept their jobs and titles. Secure. In 2016, Goldman paid $5.06 billion to the Department of Justice. When the insurance giant AIG collapsed in September 2008, the government stepped in. Emergency. AIG was Goldman's single largest trading counterparty. Goldman stood to lose billions. The Treasury Secretary overseeing that rescue was Hank Paulson, formerly the CEO of Goldman. Government rescue funds flowed through AIG to its trading partners at full value. Final. Goldman alone received roughly $13 billion, a direct flow of cash. Goldman's own chief executive, Lloyd Blankfein, told the public the firm didn't actually need saving. Testimony. Pointed questioning about whether that confidence matched what risk desks were privately saying. Lehman Brothers, a rival with no former CEO sitting in the treasury chair, was allowed to collapse. That's the loop closed. The revolving door is not an abstract metaphor for influence. It is a machine for money. In September 2008, it was worth 13 billion, very literal, very traceable dollars. Loop closed. 1MB, the one that went to prison. If 2008 was Goldman betting against its own clients, the next scandal was Goldman helping loot an entire country. In 2009, Malaysian Prime Minister Najib Razak created a sovereign wealth fund called 1MDB, intended to finance national development projects. Goldman was brought in to underwrite its bonds. Between 2012 and 2013, across 3 separate bond deals, Goldman raised $6.5 billion for 1MDB and personally collected roughly $600 million in fees. For comparison, A typical underwriting fee on a deal that size runs closer to 1% of the total raised. Goldman's effective rate here worked out to something closer to 9 times that. Internally, compliance officers repeatedly flagged serious concerns about a young Malaysian financier named Joe Low, a man with no official government role and an unexplained personal fortune, who nonetheless seemed to be present at every stage of every transaction. Those internal warnings were repeatedly overridden by senior decision makers. Roughly $2.5 billion of the money raised was almost immediately diverted into a web of shell companies. Investigators later traced some of those funds toward, among other things, financing for a Hollywood movie, The Wolf of Wall Street, a film about financial fraud funded in part by the actual proceeds of financial fraud. It is difficult to invent a detail that captures this documentary's entire argument more efficiently than that one. True, on the record, in federal court filings, money stolen from a developing country's sovereign wealth fund, raised by one of the most respected investment banks on earth, helped bankroll a major studio film, mocking exactly the kind of financial fraud that paid for it. In July 2015, the Wall Street Journal published an investigation reporting that roughly $700 million traced from one MDB into Prime Minister Najib Razak's own personal bank accounts. From that story, the entire scheme began to unravel in public. Tim Leissner, Goldman's former Southeast Asia chairman, pleaded guilty to conspiracy to launder money and to violating US anti-bribery law. Roger Ng, a former Goldman managing director, was convicted by a federal jury in 2022. Lloyd Blankfein was never criminally charged. Goldman has maintained that senior leadership was deliberately misled by employees who circumvented internal controls and that the firm itself was a victim of a small group of bad actors. The $7 billion in penalties and the guilty plea from its own subsidiary represent the closest thing to an official answer to how much of that defense regulators were willing to accept. And Goldman clawed back more than $170 million in compensation from current and former executives, including Blankfein himself. Najib Razak was ultimately convicted in Malaysia's own courts and sent to prison over his role, a rare instance where a sitting head of government was held personally accountable. Even as the bank moved on. Around the same period, Goldman was running an entirely different kind of scheme, this time on something you can actually hold in your hand. From 2010 to 2014, Goldman owned a network of aluminum warehouses in Detroit. Aluminum buyers, beverage companies, car makers, appliance manufacturers began noticing something strange. The metal they'd ordered was taking far longer than normal to actually leave the warehouse, satisfying the letter of delivery time rules while extending how long the metal legally had to sit in storage. Every extra day of storage meant extra rent paid to Goldman and helped keep a regional price premium. Reporters who visited the facilities described flatbed trucks moving the exact same pallets of aluminum between warehouses that sat, in some cases, across the street from each other. Metal that never left the complex, technically satisfying a delivery requirement while physically going nowhere at all. It looked less like commodities trading and more like a very expensive game of musical chairs, with the fees paid by everyone who actually needed the metal to build something. Coca-Cola and Miller Coors both publicly complained about rising aluminum costs traceable to the delays. A 2013 New York Times investigation and 2014 Senate hearings put the practice under a national spotlight. Goldman denied any wrongdoing, defended the arrangement as legal, and sold the business. Different asset, same underlying instinct. Find a system nobody outside the building fully understands and extract value from the gap between what it looks like and what it actually is. In 2001, Goldman structured a set of complex currency swaps for the government of Greece, financial instruments that let Greece report a smaller budget deficit than it actually had. Reports at the time estimated Goldman earned roughly $300 million in fees for the structure. For nearly a decade, almost nobody outside a small circle of officials knew the swaps existed. Then, in 2010, as Greece's actual debt crisis exploded into global headlines and threatened the entire Eurozone, the arrangement resurfaced as evidence of exactly how the problem had been hidden in the first place. Different country, different decade, different instrument entirely. Every single time, the mechanism traces back to the same idea Marcus Goldman's firm stumbled into by accident in 1906. Sell or structure something whose real value the other side has no independent way to check. None of this started with mortgages, and none of it stopped with Malaysia. In 1987, a Goldman partner named Robert Freeman was arrested for insider trading, a warning sign about internal culture that arrived 2 full decades before 2008. In 2003, Goldman was forced into a joint regulatory settlement after regulators found banks had allowed stock research to be shaped by relationships, analysts privately mocking the stocks they told investors to buy. Even where the evidence is disputed, notice the shape of the accusation. It's the same one again. A firm positioned inside a market ordinary people can't see into, using that position for an edge. In March 2012, a Goldman executive director named Greg Smith resigned in the most public way possible, with an opinion piece in the New York Times. He alleged the culture had curdled into contempt. The market reaction was its own kind of verdict. Goldman's stock fell more than 3% the day the op-ed ran, wiping out roughly $2 billion in shareholder value before lunch. Step back from any single scandal, and a larger structural question sits underneath. What happens if a firm this large, this interconnected, actually fails outright? By the time of the 2008 crisis, regulators genuinely feared that if enough of Goldman's counterparties failed simultaneously, the resulting chain reaction could freeze credit markets worldwide for months. That fear is why Goldman has since been designated a man with no official government role and an unexplained personal fortune, who nonetheless seemed to be present at every stage of every transaction. In October 2020, Goldman's Malaysian subsidiary formally pleaded guilty to a federal crime, one of the rare occasions any major Wall Street institution has admitted to committing one. Total penalties reached roughly $7 billion. In 2001, Goldman structured a set of complex currency swaps for the government of Greece, financial instruments that let Greece report a smaller budget deficit than it actually had. It was a way of using financial engineering to make a country's finances look healthier on paper than they were underneath. Then, in 2010, as Greece's actual debt crisis exploded into global headlines and threatened the entire Eurozone, the arrangement resurfaced as evidence of exactly how the problem had been hidden in the first place. Sell or structure something whose real value the other side has no independent way to check. None of this started with mortgages, and none of it stopped with Malaysia. In 2003, Goldman was forced into a joint regulatory settlement after regulators found banks had allowed stock research to be shaped by relationships, analysts privately mocking the stocks they told investors to buy. Even where the evidence is disputed, notice the shape of the accusation. It's the same one again. A firm positioned inside a market ordinary people can't see into, using that position for an edge. Describing a habit among senior staff of referring to clients using a single dismissive word, Muppets. Goldman publicly disputed the characterization, but the word stuck immediately. Section 6. The cracks. Where they are failing right now. For 150 years, Goldman's entire business model rested on selling complexity to people who couldn't see inside it. In 2016, the firm tried something almost completely new. It launched Marcus, named fittingly after its own 19th century founder, a digital retail bank aimed squarely at ordinary consumers. This time, Goldman wasn't the seller with the built-in information advantage. It was the buyer, trying to underwrite millions of individual American borrowers, a skill it had genuinely never needed to build. For a century and a half, its clients had always been institutions, governments, or the ultra-wealthy, never ordinary people with ordinary credit cards. The motivation made sense on paper. After 2008, Goldman's traditional trading and banking revenue had become far more volatile and far more heavily regulated. Executives wanted a steadier, more diversified base of earnings. Consumer banking, done well, is exactly that kind of business. Millions of small, boring, predictable payments instead of a handful of enormous, unpredictable trades. Goldman just turned out to be unequipped, spectacularly unequipped to actually run it. It did not go well. Between 2016 and 2025, the firm's consumer division accumulated massive losses, spanning Marcus Lending, the Green Sky home improvement lending business, and the Apple Card partnership accumulated more than $7 billion in cumulative losses. At one point in mid 2022, Goldman's own loss rate on its credit card loans hit 2.93%, worse than every other major US card issuer, and worse than subprime lenders. Goldman didn't just wander into a business it didn't understand. It underpriced the risk in that business more badly than the specialists whose entire model was built around pricing risk correctly. The retreat. By 2025, the retreat became a rout. Goldman sold the Green Sky lending business at a steep loss. It transferred its General Motors co-branded credit card portfolio over to Barclays. And on January 7th, 2026, JPMorgan Chase announced it was taking over the entire Apple Card partnership outright, more than $20 billion in outstanding customer balances, at a discount of over $1 billion of face value. The full transition is expected to take roughly 2 years to close. Goldman actually books this exit as a near-term win on paper. Releasing over $2 billion in loan loss reserves boosted its earnings by roughly 46 cents a share in a single stroke. That's the modern Goldman Sachs playbook in miniature. Absorb a genuine strategic failure, then find the accounting angle that turns the retreat itself into a headline about earnings growth. This closes our third loop. The firm that built a 150-year empire selling other people complexity finally had to buy something it couldn't see inside: ordinary consumer credit risk. And it lost more money on that single misjudgment than almost any of its infamous scandals ever cost it directly. Late to the next boom. The consumer failure wasn't their only misstep. While rivals like Apollo, Ares, and Blackstone spent 2018 through 2022 building dominant positions in direct private lending to mid-sized companies, Goldman moved comparatively slowly, arriving at scale only once the market was already saturated, forcing it to compete aggressively on yield rather than relationship, in a business built entirely on relationship. And in 2026, cracks are showing. Roughly a quarter of the private credit market is now tied up in heavily indebted technology companies, and AI-driven disruption to software valuations is squeezing their ability to cover interest payments. As retail investors pull money out of the publicly traded funds that hold these loans, Goldman's own asset management arm has had to offer higher yields to keep institutional money coming in, quietly compressing the very management fees that was supposed to be its stable, boring, dependable revenue stream. There's a second, subtler squeeze happening in parallel: elite boutique firms. Elite boutique firms like Centerview and Evercore pay out well over 60% of their revenue directly to staff, and they're using that to poach Goldman's top deal makers. To hold on to them, Goldman has to keep its own compensation ratio uncomfortably high, sacrificing operating margin on a $58 billion revenue year, specifically to stop its best people from walking out. Specifically, to stop its best people from walking out the door to smaller firms with no trading desk and no legacy baggage attached to their name. Even the trading floor had a rough moment. In the first quarter of 2026, Goldman's fixed income, currency, and commodities division missed revenue expectations by roughly $910 million as spreads compressed. As spreads compressed across currencies and credit products, a reminder that even the firm's most dominant divisions are not immune to a bad quarter. The generation that doesn't care. Goldman's own internal brand research reveals something the firm doesn't advertise. Trust in this name is deeply generational. For anyone who came of age before 1980, Goldman Sachs is permanently emotionally anchored to 2008. They don't see the firm as a partner. They see it as a fortress, useful for wealth preservation, kept at an arm's length. Millennials tell a stranger story. Goldman's own data shows millennials now put roughly 20% of their portfolios into alternative investments, double the rate of baby boomers. To a wealthy millennial client, Goldman isn't the villain of the housing crash. It's the exclusive gatekeeper to deals they couldn't otherwise access at all. Gen Z is different. Gen Z is the one Goldman hasn't figured out. They aren't hostile to the brand, they're indifferent to it. A prestigious 150-year-old name means very little to them. To a generation that will abandon a clunky app instantly. To manage that gap, the firm spends heavily on reputational laundering, sponsoring the McLaren Formula One team. Sponsoring the McLaren Formula One team to signal precision and elite technical prestige to corporate decision makers, and funding a small business education program called 10,000 Small Businesses, specifically to soften the vampire squid image with a story about grassroots, Main Street generosity. It is, in its own way, another version of the same instinct. Manage the perception. Manage the perception, because managing the underlying reality would cost far more. Betting the next decade on a machine. Underneath the layoffs sits a bigger bet. Goldman has launched what it internally calls One Goldman Sachs 3.0, an operating model built around artificial intelligence, organized across 6 internal work streams, meant to compress years of manual analyst work into automated pipelines a fraction of the size. Executives have set a public target of growing alternative assets toward roughly $750 billion by 2030, treating AI-driven efficiency as the engine that funds that expansion without proportionally expanding headcount to match. Independent analysts modeling the firm's next 5 years put its probability of continued dominance through 2030 somewhere in the range of 85 to 95%. The other 5 to 15% is the whole reason this documentary exists. Because every time this firm has bet its future on a system nobody outside could fully verify. The story eventually found its way to a courtroom, a settlement, or a headline exactly like this one. 2026, The Irony. And here is where it gets almost too on the nose. In early 2026, Goldman Sachs' own research division published a report warning that American workers displaced by AI face longer job searches and real measurable pay cuts. That same year, Goldman quietly retired its traditional annual layoff process, a once-a-year review nicknamed internally the Strategic Resource Assessment, in favor of smaller cuts. In favor of smaller, continuous, rolling job cuts running through the year across every division, explicitly tied to the firm's own push toward AI-driven efficiency. The firm that publishes research warning the country about the human cost of AI-driven job loss is in the very same year restructuring its own workforce around exactly that principle. Just quietly, and a few employees at a time, so it never has to become one single large headline. Layered underneath all of it, in 2023, Goldman paid a massive settlement, $215 million to settle Chen Oster versus Goldman Sachs, a class action alleging systemic gender bias in pay, promotions, and performance evaluations, affecting thousands of women across more than a decade. And junior employees have repeatedly described brutal working conditions. A 2021 internal survey conducted by first-year analysts themselves, leaked publicly, described sustained 100-hour work weeks and lasting effects on physical and mental health. The firm publicly promised reform. Complaints about extreme hours have continued to surface in the years since. Section 7. The verdict. Flaws, strengths, solutions. What Goldman Sachs is genuinely best at. Before the final verdict, credit where it's earned, with the same precision we've just given the failures. First, Goldman is, by a wide margin, the world's most trusted advisor for the hardest deals in corporate finance. Hostile takeovers, activist investor defense, multi-billion-dollar restructurings. Boards hire Goldman partly for the advice itself and partly because hiring Goldman functions as a kind of legal insurance. If a deal goes wrong afterward, no shareholder can credibly argue the board failed to secure elite counsel. Second, when Goldman finally accepts that a strategy is failing, it kills it fast, without sentimentality and without waiting for a face-saving exit. The firm poured nearly a decade and $7 billion into consumer banking, and rather than doubling down out of institutional pride, it dismantled the entire effort in under 3 years once the numbers became undeniable. Plenty of larger, slower institutions have burnt far more money. Third, the firm's financing arms, the unglamorous business of lending against trades and holding collateral for hedge funds, now generate over $11 billion a year in steady, predictable revenue. It's the least exciting part of Goldman Sachs, and arguably the most important, because it means the firm is no longer purely a casino betting on which direction markets move next. Fourth and simplest, the numbers right now are genuinely excellent. 2025 net revenue came in at $58.3 billion, up 9% year over year, with earnings per share of $51.32, 27% growth in a single year, and return on equity at 15%, up from roughly 10% in 2019. Whatever else is true about this firm, it is not currently a company in decline, and the deal-making machine keeps proving itself in real time. In June 2026, Goldman served as lead left book runner on SpaceX's $75 billion public offering, one of the largest and most closely watched listings of the decade. Exactly the kind of marquee assignment that keeps the world's most valuable private companies calling Goldman first when it's finally time to go public. The firm has also been buying its way into adjacent growth areas rather than waiting to build them from scratch, acquiring the private market specialist Industry Ventures for close to $1 billion. Executives internally describe the strategy as one Goldman Sachs, the idea that a wealthy client, a corporate board, and a hedge fund manager should all be quietly cross-sold into every part of the firm, multiplying the value of a single relationship many times over. In practice, that might mean the same corporate client whose IPO Goldman underwrote also ends up banking with their private wealth arm, borrowing through its financing desk and holding its excess cash in a Goldman money market fund, four separate revenue lines built on top of one original relationship, making the client expensive to leave. The three structural problems. Now, the honest problems, stated with the same specificity as the achievements. 1. The compensation structure. 1. Goldman's official business principles say the client comes first. Its actual promotion and compensation structure has, for decades, rewarded the person who closes the biggest deal, not the advisor. Not necessarily the advisor whose client came out best over the long run. An institution cannot fully fix a trust problem while continuing to pay people according to the exact value system that keeps recreating it. 2. The revolving door between Goldman and Washington is not illegal, and most individuals who walk through it have been highly capable public servants. But the sheer frequency of the pattern means the firm's own regulators have disproportionately often been its former employees, and no compliance department can fully eliminate the appearance. 3. Goldman's culture is genuinely dominant when applied to problems it already understands deeply. The moment it steps into a domain built around ordinary human behavior, consumer credit, retail trust, everyday spending psychology, the exact same instincts that make it dominant on Wall Street make it strikingly, measurably bad at Main Street. And a fourth, quieter problem sits underneath the other three: succession risk. David Solomon has run the firm since 2018, with John Waldron widely viewed internally as his likely successor. A firm this dependent on a small circle of senior relationships and institutional memory is only ever one leadership transition away from discovering how much of its culture was held together by people. What a smarter Goldman Sachs would do differently. A more disciplined version of this firm would tie a meaningful share of every senior banker's compensation directly to long-term, multi-year client outcomes. It would voluntarily impose a formal cooling-off period before senior alumni move directly from Goldman into the specific government agencies that regulate them, not to punish public service, and it would accept permanently that its core competitive advantage is institutional trust among sophisticated buyers, and stop periodically attempting to refight that same advantage in markets built on retail trust. Finally, it would treat brand perception as a downstream consequence of behavior rather than a marketing budget line item. Reputation has to be rebuilt through decades of decisions. The framework, closing the first loop, which finally brings us back to where we started. Why does something that happened in 1929 explain a scandal happening in 2026? Because the pattern. Because the actual pattern was never really about the mortgage bond or the sovereign bond. The pattern is this: whenever an institution sells something whose true value the buyer cannot independently verify. Next time you hear about a firm's genius new financial product, ask one question before you invest a single dollar in it. Who can actually verify what's inside it? And who personally gets paid if it fails? If the honest answer is nobody, and then the people running it in that exact order, you are not looking at innovation. You are looking at 1929 wearing this decade's clothing. Goldman Sachs did not survive 150 years by being the smartest firm on Wall Street. It survived by being the firm best able to make its own risk someone else's problem. Publics in 1929, the taxpayers in 2008, and entire countries in 2012, and to do it again cleanly every single time the last version had been safely forgotten. But there is one kind of risk Goldman Sachs has never actually figured out how to offload onto somebody else. The risk of being wrong about something it can't simply out negotiate its way out of. Marcus and the Apple Card proved that much, at a cost of $7 billion and counting. Next time, we go inside a company that doesn't just advise on where the world's money moves. It quietly decides where nearly all of it sits in the first place. A firm so deeply embedded in the ownership structure of the global economy that it's one of the largest shareholders in most of its own competitors simultaneously. Here's what you need answered before you can look at your own investments. How does one company end up as one of the largest shareholders in Coca-Cola and Pepsi, in Boeing and Airbus, in almost every major bank on earth, all at the same time? And what actually happens the day it decides to use that vote? BlackRock is the story of a firm that never had to be. Set a reminder. You'll want to see this one. This is Strategy Lens. We open the files, subscribe, and you'll be first in the room the next time one of these doors gets pried open. Every documentary in this series ends the same way it begins, with a number, a name, and a document trail that was always public, just never assembled in one place until now. Goldman Sachs didn't build an empire on being right. It built one on making sure nobody outside the building could ever check.